Economics yesterday, inflation. Michael McKee has a different series this morning. Michael, what do you have?
Well, popular pressures of inflation are still with us. The producer price index for March shows a stronger than expected gain, up 1.4% on the month. The forecast was for a 1.1% gain. Last month, it was up 0.9%, which is a tick higher than the initial result. On a year-over-year basis, the PPI for final demand comes in unchanged, it looks like.
Yeah, I see an inch there.
Yeah. Final demand.
I have no idea what that number means.
Take out food and energy, and the core rate up 9.2% on the year. That's much stronger than the 8.4% last month. The other thing to look at here is the index for goods versus services. Index for final demand goods up 2.3% in March, while for services up just 0.9%. We saw the goods in the CPI decline in March as services rose, but that is not the case in the pipeline.
Right. Let me get a question to you, Mike. I think it's really important here. PPI, you and I are old enough to remember when this was a huge deal. Is it a huge deal again?
No. It basically contributes to the ongoing belief that we are in an inflationary cycle and the Fed has to move. Yesterday, Tom Barkin of Richmond strengthened his view, saying we should move very quickly to neutral. He's sort of joining the Jim Bullard camp and then see what happens.
What have you learned in 24 hours about the duration of this inflation? When you look at core 6-ish, PPI core 9-ish, how has Michael McKee's sense of the duration of this bout of inflation changed?
Looks like it's going to take quite a while to bring it down. I mean, we may have reached the peak in CPI.
Quite a while, like when the Red Sox start winning, or what?
Let's hope they start picking up the pace a little bit sooner than inflation.
Mike, I do want to just tell you, we were looking at what that number would be for the PPI final demand. It took a while to come in. It did come in 11.2%. The expectation was 10.6%. We are seeing markets respond somewhat in the way you would expect, with yields up slightly. Not a massive reaction, but still we are seeing the S&P futures erase gains. And we're looking right now at a market with a new inflationary dynamic affecting the pipeline, as you said, 11.2%, Mike. Can you put that into perspective?
Well, it's the most since 2010, which is better, I suppose, than the 1981 number from yesterday, although they changed the PPI calculations around that time, so we don't go as far back. But it does just suggest that there are still strong pipeline pressures, which doesn't surprise anybody, given the fact that we're seeing all kinds of interruptions to supply lines and interruptions to agriculture from the war in Europe, and so a lot going on that pressures prices. One other number I wanted to mention today, and if we can bring this up, the MBA mortgage application is not something we follow on a regular daily basis because it's very high-frequency data, down another 1.3% last week. But the thing that is really interesting about it is that, as expected, it falls as rates rise, but more and more people, 25%, are switching into adjustable rate mortgages. Now, that could be because they're about a percentage point cheaper now than the fixed rate mortgage, but over the next couple of years, if the Fed follows Tom Barkin and Jim Bullard's advice and we end up at 3 or 4%, is this a bet by the American people that the Fed will be able to bring inflation down and will be cutting rates before their arms reset?